Hello, everyone. I'm Bosa, and I'm a principal in the investment team at Coller Capital, based in London. Let me start by thanking you for making the time to join us for our Barometer webinar. I'm joined today by one of my colleagues, Daisy Huang, who is an investment principal based in New York. Together, we will present the results of our latest barometer. Throughout the session, you will have the opportunity to submit questions. You can do this by using the Ask a Question button, and we will follow up with you with responses. Coller Capital's Global Private Equity Barometer is a unique snapshot of worldwide trends in private markets. It's a twice-a-year overview of the plans and opinions of institutional investors based in North America, Europe, and Asia Pacific. This 37th edition of the Barometer captured the views of 112 private equity investors from around the world. They were surveyed over a period between the 20th of September and 4th of November 2022. Its findings are globally representative of the LP population by location, type of organization, total AUM, and length of private equity investing experience. The results show a shift since the summer of 2022 barometer, where various indicators, such as future target allocations and the number of LPs achieving private equity returns of over 16%, signaled a possible inflection point in the markets. With economies and markets in turmoil since then, the winter report is the first chance to see how LPs are changing their positioning. First, a bit of background. The survey questions were answered by LPs in volatile times, with inflation at levels not seen in recent decades, supply chain issues globally, and high energy costs leading to an energy crisis. To combat inflation, central banks are increasing interest rates sharply, which is proving to be a tricky balancing act in an era where markets have become addicted to cheap money. In addition, world leaders are facing significant challenges in their domestic agendas, and tensions between the world's superpowers remains high. Severe economic difficulties are already apparent in several countries, with the likelihood of a global recession looming large. As LPs assess the risks and opportunities of the current environment, reshaping investment approaches and portfolios will become a priority for many of them. With that background in mind, let's turn to the findings, starting with the risks to private equity returns over the next 2 to 3 years. This is a question we ask every few years, enabling us to compare the results, this time to the findings from the winter 2018 to 2019 barometer. Unsurprisingly, nearly all LPs have concerns over the macro environment, believing it is a risk to private equity returns, and 85% of LPs had the same concerns over inflation. Note that we didn't ask about inflation as a risk to private equity returns in 2018, as inflation was stable at a low level and not expected to move by much at all. Conversely, when compared to investor concerns 3 years ago, fewer LPs are worried about the impact of high asset prices on private equity returns. This follows a decline in valuations as public markets have fallen, although there is still some revaluation of private assets to come through. We next asked LPs for their views on public versus private markets in the current volatile environment. For North American and European LPs, around a third believe that the volatility has made private equity more attractive than public equity. More Asia Pacific LPs are positive in private equity's favor. We asked that same question for credit markets, and again, around a third of LPs in North America and Europe view private credit as more attractive than public credit. Asia Pacific LPs' views are more balanced, with 19% of LPs saying private credit has become more attractive versus 24% that believe it has become less attractive. Every barometer, we ask LPs about their plans for target allocations over the next year, and this time we have seen a shift in their intentions. 1/3 of LPs plan to increase their target allocation to alternative assets over the next 12 months, compared to half of LPs that were planning this 6 months ago. Fewer LPs are planning increases in their allocations to private equity, infrastructure, and real estate. LP plans for private credit are holding steady compared to the Barometer summer 2022. The private credit market has grown rapidly over the years. According to Preqin, private credit has assets under management of $1.2 trillion held in fund structures alone. And the market is made up of more than just assets in private credit funds. It also includes leveraged loans, BDCs, preferred equity, NPLs, and CLOs, all summing up to an estimated $2.4 trillion in 2021. This continuing growth is reflected in LPs' plans for commitments to private debt funds, where a quarter of LPs plan to increase their private debt fund commitments in the next 12 months. And 2/5 of LPs view senior direct lending and special situations as attractive areas of private credit, with 1/3 of LPs viewing structured credit and mezzanine debt as attractive. So we've covered allocations. Now let's have a look at investors' forecasts for returns from their private equity portfolios. Every winter, we ask LPs to predict the returns they expect to achieve from their private equity portfolios, and in the summer, LPs report the actual returns they have achieved. Last summer, the percentage of LPs who reported net annual returns of over 16% across the lifetime of their private equity portfolios hit a high point, having been exceeded only once in 2007 in the run-up to the global financial crisis. In the winter barometer, LPs have remained optimistic, with 1/3 of LPs forecasting net annual returns from their private equity portfolios of over 16% in the next 3 to 5 years. We will have to wait till the next report to see if LPs are being too optimistic or if their belief in private markets performing better than public markets holds true. The outperformance of private equity portfolios relative to public equities has led asset allocations to become unbalanced for some LPs. In certain cases, this can mean that LPs have to sell down their private equity assets so the overall portfolio is back in balance, something we call the denominator effect. 2/5 of LPs report that the denominator effect is likely to cause a reduction in the pace of their private equity fund commitments over the next 1 to 2 years. And the number is bigger for large LPs, i.e., those with assets under management of over $20 billion, and public pension funds, where 2/3 of LPs report the denominator effect as being a factor in the slowdown in their commitment pace. And with distributions from GPs slowing down, over a quarter of LPs said that liquidity shortfalls will lead to a reduction in commitment pace. I'll now hand over to Daisy to present the rest of the findings.
Thank you, Bosa, and hello, everyone. In terms of positioning, 3/5 of North American LPs believe that their private market portfolios are well positioned in the context of today's market conditions. Conversely, the remaining North American LPs think that while their portfolios are well positioned for the most part, some further modifications would be helpful. In other regions, while the majority of European LPs felt well positioned, 2/3 of Asia Pacific LPs believe their portfolios would benefit from further modifications. Of those LPs who believe that their private market portfolios require some modification, 2/3 would do so by making changes to the investment stage and/or sector exposure of the portfolio. And over half of LPs would make changes to the asset classes and or the geographies in which their portfolios are invested. One way LPs are making modifications is by accessing the private capital secondaries market. Just over half of LPs plan to utilize the secondary market in the next 2 years, either as a buyer or a seller, or both. And 1 in 5 LPs plan to both buy and sell assets. This is supporting market volume for secondaries. We forecast secondary market volume for 2022 to be around $130 billion, with a shift from the 50-50 split between LP-led and GP-led transactions in 2021 now weighted more towards LP portfolio sales as LPs start to address the denominator effect. LPs are also addressing the impact by reducing private equity target allocation for the next 12 months, as we saw earlier. We also asked LPs about specific sectors in the barometer, focusing first on technology given the volatility in the sector. Over a quarter of LPs say that volatility in the current environment has reduced the attractiveness of private equity investments in technology, and almost half of LPs believe the same is true for venture capital technology investments, most likely due to its higher risk profile. Secondly, we ask LPs for their plans to invest in private equity energy assets, where more LPs are investing in PE energy assets, both in renewables and hydrocarbons, than 4 years ago. The number of LPs investing in private equity energy assets has risen since the 2018-2019 Winter Barometer. 69% of LPs are either starting, maintaining, or increasing investment in renewable energy compared to 55% of LPs in 2018. Hydrocarbon private equity investing is also attracting more investors, with 42% of LPs starting, maintaining, or increasing investment compared to 36% of LPs in 2018. The results are understandable in the context of the energy crisis. Interestingly, the most changed view for investing in hydrocarbon private equity assets between 2018 and 2022 is driven by a shift in European LPs' positioning, most likely due to the energy crisis in Europe outweighing the region's strong stance on ESG considerations. Here, you can see the growth in PE and VC-backed investments in European renewables and traditional energy over the past few years, with a sharp jump in recent times. We also took a regional focus to some of our questions, focusing on PE markets in Europe, Asia Pacific, and the US. In Europe, we asked LPs how attractive they viewed individual markets compared to 2 to 3 years ago. 3/5 of LPs view Central and Eastern Europe as a less attractive market for private equity compared to 2 to 3 years ago, with the war in Ukraine weighing heavily on the region. 2/5 of LPs think the same about the UK private equity market, and note that the results for the UK were answered around a time of change in political leadership and the negative fallout from the new government's mini budget. The Nordics bucked the trend, on balance being viewed as becoming a more favorable destination for private equity. Private equity markets in Asia have been growing quickly in recent years. This chart from Preqin shows the region's progress in terms of Asia Pacific private equity assets under management. Given this growth, we were interested in how LPs are investing in the region, and the results show the different routes taken by LPs. 2/3 of European and North American LPs make most of their Asian private equity fund commitments through regionally focused funds, whereas Asia Pacific LPs are invested both in regional funds and also in country-specific funds. In the US, we focused our questions on the possible change in how private equity is regulated and any impact this would have on PE returns. Just over half of LPs believe there is likely to be a tightening in the regulatory environment for private markets in the US in the next few years, Although it's important to note that LPs were asked to complete the survey around the time of the US midterm elections, where the outcome was uncertain, which could have led to the split view. A quarter of LPs believe that any change in US regulation will have a negative impact on their US private market returns, with only 5% of LPs thinking any impact will be positive for returns. ESG is a subject we have covered in the Barometer for many years. This time, we asked LPs their views on GP disclosure, with a focus on relatively new regulation in Europe and the US. Three-quarters of LPs told us they would consider stopping investing in a fund if the GP did not reach certain standards of ESG-related disclosure in 3 years. Some LPs have confidence in their ability to assess a GP's ESG measurement systems. A majority of European and North American LPs believe that their institutions are broadly fit for purpose in their ability to assess a GP systems, whereas more Asia Pacific LPs thought their institutions were unfit for this purpose. We finished with a few findings focused on how LPs invest across a GP's platform, where gaining more influence with a GP is seen as a major advantage by half of LPs that invest in multiple products from the same manager. Other advantages cited include access to other investment opportunities, reduced fees, lower levels of due diligence for additional products, and a lower administrative burden. Another popular route of investing with a GP is via separately managed accounts or SMAs. One-third of LPs have SMAs, which is in line with the number reported in the 2015-2016 Winter Barometer. LPs at corporate pension funds and public pension funds utilize SMAs considerably more at 67% and 54% of LPs, respectively. And these accounts are performing for LPs. One quarter of LPs with SMAs say that these are outperforming their private equity portfolios. That concludes our findings. In this barometer, investors are telling us LPs view the macroeconomic environment as a significant risk to PE returns. The denominator effect is likely to reduce the pace of PE commitments. LPs are modifying their portfolios and utilizing the secondary market, and more LPs are investing in PE energy assets, both renewables and hydrocarbons. The Barometer is a publication of the Coller Research Institute. You can find more information about our reports on the research section of the Coller Capital website. There is also an option to subscribe to our research for future publications. Alternatively, reach out to any member of the Coller team and we will arrange to send you a copy. That concludes our presentation. For those of you who have submitted questions, we will follow up shortly. Thank you very much for watching.